Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about G-Iii Apparel Group Ltd. Annual Report. G-Iii Apparel Group Ltd. offers a diverse range of businesses and services across the apparel industry. The company operates through two main segments, wholesale operations and retail operations. In terms of products, G-Iii provides outerwear, dresses, sportswear, swimwear, women's suits, performance wear, suit separates, athleisure, jeans, handbags, footwear, accessories, small leather goods, cold weather accessories, and luggage. The company markets its products under both own brands and licensed brands. Its own brands include Andrew Mark, DKNY, Donna Karan, Eliza J. G.H. Bass G-Iii for Her, G-Iii Sports by Carl Banks, Jessica Howard, Karl Lagerfeld Paris, Mark New York, Sonia Reichel, Vilebrequin and Wilson's Leather. On the other hand, its licensed brands include BCBG, Calvin Klein, Champion, Cole Haan, Converse, Dockers, French Connection, Halston, Kenneth Cole, Kensie, Levi's, Margaritaville, Nautica, Tommy Hilfiger, and Vince Camuto. In addition to its product offerings, G-Iii also engages in licensed team sports business. The company has partnerships with prominent sports leagues such as the National Football League, National Basketball Association, Major League Baseball, and National Hockey League, as well as U.S. colleges and universities. This partnership allows G-Iii to distribute its products through various channels, including retailers, digital platforms, and online retail partners. G-Iii Apparel Group Ltd. Market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. G-Iii Apparel Group Ltd. trades at a higher price-to-earnings ratio of 18 times and a lower price-to-book ratio of 0.65 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap? The company maintains a moderate leverage profile, with liabilities making up 32% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company's net income and profit margins experienced significant declines in fiscal year 2026. Net income decreased by $126.2 million compared to the prior year, with a staggering 65% drop from $193,293 to $67,353. This decline was driven by various factors. One major contributor to this decrease was a reduction in net sales due to lower unit shipments, despite a slight increase in average prices. Additionally, the company faced a negative impact on its gross profit percentage in the wholesale operations segment due to tariffs. Furthermore, an increase in selling, general, and administrative expenses also weighed heavily on the company's bottom line. As a result of these factors, the company's profit margins suffered significantly. Gross profit margin decreased from 40.8% to 39.4%, while operating profit margin plummeted from 9.1% to 3.7%. The net income margin also declined sharply, from 6% to 2.3%. These changes indicate a substantial decline in the company's profitability and efficiency. The company's financial performance has shown a significant improvement in recent years, with a notable increase in its ability to generate cash from its core operations. One key indicator of this is the positive operating cash flow, which reflects the company's efficiency in managing its day-to-day activities and generating revenue. According to the latest available data, the company generated $299.1 million of cash from operating activities in fiscal 2026. This substantial amount indicates a strong ability to convert earnings into actual cash, which is essential for investing in growth initiatives, paying off debts, and returning value to shareholders. The positive operating cash flow also suggests that the company's operations are profitable and sustainable, providing a solid foundation for future growth and success. The company's debt level has undergone significant changes over the past few years. Initially, the debt level increased to $700 million in fiscal 2025 due to an amended ABL credit agreement. However, this was partially offset by the redemption of senior secured notes worth $400 million in August 2024. Furthermore, long-term debt obligations decreased by $1.3 million from $13.1 million to $11.8 million. In terms of interest expenses, there has been a mixed trend. On one hand, interest expenses have increased due to variable rate indebtedness and interest rate risk. However, this increase was partially mitigated in fiscal 2026, when interest and financing charges decreased from $18.8 million to $0.5 million. Nevertheless, the company expects interest expenses to rise further due to potential interest rate increases. Overall, while there have been fluctuations in both debt levels and interest expenses, the company's financial situation remains dynamic and subject to various factors, such as changes in interest rates and debt obligations. The performance of various regions and segments can be observed from the extracted summaries. On a positive note, Hong Kong stood out for having a managed currency value relative to the US dollar. This stability likely contributed to its overall economic growth. In contrast, China's Xinjiang Uyghur Autonomous Region faced challenges, although specific details were not provided. The region was mentioned alongside Europe and Hong Kong, suggesting that it may have been impacted by global market trends or regional issues. Other international markets also experienced difficulties due to associated risks with international operations. At the company level, G-Iii Apparel Group's performance was mixed. The company saw an increase in its effective tax rate from 26.1% in 2024 to 39.2% in 2026. This rise may be attributed to various factors, such as changes in tax laws or increased profitability. Additionally, the company recorded significant impairment charges related to its investments in e-commerce retailers and Saks Global/SaksOff5th.com. These charges totaled $45.8 million, indicating potential losses or write-downs of these investments. Management at G-Iii Apparel Group Ltd. is optimistic about the company's outlook despite facing several challenges. The key strategies in place aim to drive growth through diversification, digital transformation, and supply chain optimization. These efforts have already shown positive results, with net sales growth of 10% in fiscal 2026 and a 16% increase in net income. However, management is aware of the potential risks associated with inflationary pressures, interest rate volatility, and global economic uncertainty. The company is working to mitigate these challenges by optimizing its supply chain operations and developing its own brands. Despite these efforts, G-Iii still faces intense competition in the apparel industry, which may impact market share and profitability. Management's strategy focuses on building a strong foundation for long-term growth, rather than solely relying on short-term gains. By investing in digital channels and developing its own brands, G-Iii aims to increase revenue and profitability while reducing its dependence on licensed brands. Overall, management is confident that these strategies will help the company navigate the current market challenges and achieve sustained growth. The company's financial activities have been documented in various pages of the extracted summaries. One notable aspect is its dividend payment history, which confirms that the company has indeed paid dividends, page 37. This indicates a commitment to returning value to its shareholders. Regarding share buybacks, initial information on page 37 was inconclusive. However, subsequent confirmation on page 49 revealed that the company did engage in share repurchases. Furthermore, detailed financial data on page 53 specified the exact amount of $49.8 million allocated for this purpose. Concerns about inventory buildup and supply chain disruption are prevalent throughout various pages of the extracted summary. One major concern is the potential for extreme weather conditions to diminish demand for seasonal merchandise, leading to inventory buildup. Additionally, severe weather events can disrupt distribution centers, causing higher costs and longer lead times. The logistics and distribution systems are also vulnerable to security risks, computer viruses, and system failures, which can further exacerbate supply chain disruptions. The dependence on third-party services, such as transportation and warehousing, makes the distribution capacity susceptible to natural disasters or travel restrictions. Fluctuations in raw material prices and availability can affect the cost of goods sold and ability to meet customer demands. Raw materials are also vulnerable to adverse climate conditions, animal diseases, and natural disasters, which can lead to increased costs related to transport of products. Inventory buildup is a significant concern due to excess inventory resulting from failure to anticipate changes in customer preferences, tastes, and trends. Inventory shortages due to delayed shipments from foreign manufacturers can also occur, leading to potential missed opportunities, markdowns, and write-offs. Supply chain disruptions are further complicated by geopolitical tensions, reciprocal tariffs, and conflicts in the Middle East, which negatively impact global supply chains and critical shipping routes. The imposition of tariffs on imports from China, Vietnam, and Bangladesh has caused importers to shift production to lower tariff territories, impacting their ability to plan production schedules and secure capacity with ocean carriers. Overall, the extracted summary highlights numerous concerns about inventory buildup and supply chain disruption, emphasizing the need for companies to continually evaluate and adapt to changing market conditions. That concludes the financial summary for G-Iii Apparel Group Ltd. Feel free to comment below, and I will be happy to answer them when possible.